Hello, and thanks for joining me and watching this video where we try to answer the question, is the stock market too expensive right now? Are we in a bubble? Are many of us speculating like we're in a casino? The reason I use that phrase is because Warren Buffett recently suggested that. So what I'd like to do is look at a number of indicators to help answer those questions. Because as you know, this graph shows, the value of stocks going up over time. That may be supported, it may be appropriate, or it may not. I chose the S&P 500 for this simple graph. Could have used the Nasdaq, the Dow. They even increased at steeper rates over this time period. So now it feels like, wow, things have gone up pretty consistently. Is that going to continue? So we're asking, is the bubble about to pop? Most answers are too simple, too confident, or just want you to invest in gold. It seems like every time I read a story about the market and it kind of starts with, oh, we're in trouble. Oh, yeah, so-and-so says we're headed for a correction. You better invest in gold. And as soon as it does that, it just loses all credibility because, the whole purpose of that story was to scare me into buying gold. But and we'll probably do this in another video, but if you compare gold versus the stock markets over time, gold is never a preferred long-term investment. But you probably already know that. So people want a metric, formula, or method that will help them time the market. But that's not really how it works. We can't predict timing perfectly. No one can tell you when the market will crash, correct, recover, surge. And if you do pull your money out right before the crash, you have to, great, you are correct on one of the two ends. You also have to predict correctly when to put it back in, because as you know, the markets can recover very quickly. So there's key signals that can tell us if the market is expensive or undervalued relative to history. And that's what we're going to do. We're going to look at those signals, and it'll help us make buy and sell decisions, or probably more likely help us make decisions of, do we want to diversify in some ways or reduce our exposure to the stock market for a few months or a couple years if we think a correction is coming. I think it's rare for people to pull 100% out of the market because dollar cost averaging is a great strategy, and it's been proven over time. And the markets have always historically recovered from the downturn. So anyway, what I'm trying to do is just evaluate whether the risk is higher than normal, and should we behave differently due to that. So what we're going to do is in the next few videos, we're going to dive into some key signals, CAPE ratios or CAPE index, Case-Shiller index. It basically tells us the same thing. It's a smooth view of price versus earnings. It helps us look at trends. That's very useful. Next, we're going to look at market cap to GDP. That's Warren Buffett's preferred measure. Then we're going to go into liquidity and macro data, sentiment and behavior, margin and debt levels, inflation and unemployment. So each one of these 6 signals will give us, we're going to rate it on a red, yellow, green stoplight indicator and see if they're all red, or see if we have a mixture of ratings or signals telling us what to do. And so we'll compare those signals to past as well to help us, because history will help us here. We'll look at the dot-com bubble, we'll look at the roaring 20s, we'll look at the 2008 housing crisis, and not to necessarily predict the timing of a correction or a recovery, but to evaluate what combinations of signals have historically produced lower returns and what combinations have historically produced higher returns. That could be useful in then helping us protect our nest eggs. So it'll be fun. We'll see how it turns out. See, whether it's all reds, all yellows, or a mixture with some greens as well. So please join me as we explore the history of the markets, the signals, and what it means for us today. Okay, thank you.